Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, let's get straight to the tape, because the numbers we're seeing on Critical Metals Corp, ticker CRML, are, well, they're frankly impossible to ignore. On Friday, January 16th, 2026, the stock closed at $17.65. But the price is just the tip of the spear here. We're watching daily trading volumes exceed 20 million shares. To, put that in perspective for everyone listening, the market is effectively turning over a massive percentage of the entire available float in single trading sessions. The stock is up 123.4% in the last month alone. It has surged 330.5% over the last 3 months. I mean, the velocity of money moving through this equity is staggering.
It is. It's an absolute frenzy. There's no other word for it. And while those percentages are eye-watering, we have to address the reality of what those numbers represent, and we have to do it immediately. We're seeing a pre-revenue mining company exhibiting the volatility profile of a leveraged crypto or, a meme stock in the middle of a squeeze. So the central question we're debating today is whether CRML is a legitimate mining equity being successfully repriced as a Tier 1 national security asset, or if it has simply become a financial derivative for gamblers betting on United States foreign policy in the Arctic.
I think framing it as gambling fundamentally misses the shift in the geopolitical landscape that we are living through right now. Look, this isn't just a mining stock anymore. What the market is effectively pricing in is a geopolitical call option. The valuation reflects the immense strategic necessity of U.S. dominance in Greenland. We're looking at a potential acquisition, or at the very least, a strategic lockup of the Tanbreeze project to solve the gallium crisis. And this is supported by what I consider a game-changing $1.5 billion joint venture term sheet with TQB in Saudi Arabia.
And that is exactly where I draw the line. You're calling it a strategic option. I see a decoupled asset bubble driven by prediction markets and, frankly, Trump trade mania. You have a company with zero revenue, a $10 million annual net loss, and significant insider selling pressure, yet it commands a market capitalization of $2.09 billion. That's priced for perfection in a world where mining projects rarely go perfectly.
I understand the skepticism regarding traditional metrics. I do. If you look at this through the lens of a standard PE ratio or revenue multiples, of course it looks expensive. But I would argue those models are, they're irrelevant here. We are dealing with option value on a sovereign acquisition. If the United States moves to acquire or heavily subsidize Greenland's resources, the traditional mining economics are thrown out the window.
But you can't just throw economics out the window because the story is good.
You can if the strategic value outweighs the commercial value. Consider the gallium factor. The Tanbreeze project contains high-grade gallium, up to 122 parts per million. Why does that matter? Gallium is the essential component for AESA radars on fighter jets, for 5G networks, for next-generation semiconductors. Right now, China controls 98% of global gallium, and they are imposing export restrictions. Tanbreeze isn't just a mine, it is a hedge against the weaponization of military supply chains. That is what the premium is for.
Okay, I'm not disputing the geology, although we should get to the specifics of that later because geology is complex. I am disputing the financial reality of the equity right now. Let's just look at the technicals. We're looking at a relative strength index, or RSI, of 73.86. For our listeners who don't trade technically, typically anything over 70 is considered overbought, suggesting momentum is peaked. Furthermore, the price is trading nearly 150% above its 200-day moving average, which sits way down at 726. That kind of gap suggests the stock has run too far, too fast, purely on sentiment. And regarding that Saudi deal you mentioned as game-changing, we need to be precise. It is a non-binding term sheet.
It's a term sheet with a major partner.
It is non-binding. In the junior mining world, non-binding term sheets are a dime a dozen. They're marketing documents until ink hits paper on a binding contract. Until that happens, that $1.5 billion figure is theoretical. Meanwhile, the whole Greenland purchase narrative is, at this stage, just political rhetoric.
Well, it is more than rhetoric when you look at the structure of that Saudi deal, binding or not. The term sheet outlines a carried interest structure. And this is the holy grail for junior miners. Usually, to build a $1.5 billion plant, a small company has to issue millions of new shares, diluting their current investors down to nothing. But carried interest means CRML does not have to dilute its shareholders to fund its 50% share. TQB, the Saudi partner, puts up the capital. CRML is effectively the only pure-play proxy for the Greenland narrative. If you believe the U.S. government is serious about the Arctic, this is the only instrument to trade that thesis.
But that instrument is being manipulated by external betting markets. And that brings me to the most concerning correlation I've seen in years. The stock price of CRML is tracking the Polymarket.com odds for "Will USA acquire Greenland?" almost 1-to-1.
I would argue that prediction markets represent a very sophisticated form of sentiment analysis. It's the wisdom of the crowd in real time.
It makes the stock a gambling token, not an investment. Look at the data. The odds on Polymarket surged from under 6% in December 2025 to a peak of around 15% in mid-January. The stock chart is a mirror image of that line. This implies that algorithmic traders, computers, not humans, are scraping the API feeds from Polymarket and triggering automatic buy orders on CRML whenever the betting odds tick up. And here is the danger. If those odds drop from 15% back to 6%, maybe because of a firm denial from Copenhagen or just a lack of news, the stock crashes. You aren't investing in a mine, you're leveraging a bet on a political outcome over which the company has zero control.
I see why you think that, but I view the prediction markets as smart money. We are seeing over, $13.8 million in volume on that specific Polymarket contract. That is not just retail noise. That is institutional capital trying to price in a binary event. The market is correctly identifying that UF control unlocks the Defense Production Act, or DPA, funding. It unlocks Department of Energy loans. It effectively allows CRML to bypass the slow, grinding capital markets that kill most junior miners. So even without a full purchase of the island, mere U.S. dominance secures the asset. The market is pricing in the probability that the U.S. government becomes the primary capital backer.
That is a massive if. And while we wait for the White House to make a move, we have to look at how the peers are trading to see just how inflated this price is. Let's compare CRML to Standard Lithium, ticker SLI. Both are developers, meaning they aren't selling rock yet. But SLI is in Arkansas, a safe jurisdiction with established infrastructure. SLI trades at a $1 billion market cap. CRML trades at roughly $2.1 billion. You're asking investors to pay a $1 billion premium, literally double the valuation for political speculation in a difficult Arctic environment.
Standard Lithium is a fine company, but it's not a valid comparison. You're comparing apples to oranges because of the strategic weight of the elements involved. A better comparison is MP Materials, which trades at $12.2 billion.
MP Materials is a producer. They are profitable. They produce 15% of the world's rare earths. CRML has zero production. You cannot compare a company printing cash to a company burning it.
But if Tanbreeze is nationalized or fully supported by the DPA, CRML deserves a producer multiple, not a developer multiple. We have to look at the scale. Tanbreeze hosts 4.7 billion tons of resource. It is arguably the largest rare earth deposit globally. The scale here is something MP cannot match. And unlike the carbonatite deposits that MP mines, Tanbreeze is a Cockratocalite intrusion.
Okay, you're getting into the weeds. Explain why that matters financially.
It matters because of the mix. Carbonatites are usually rich in light rare earths like neodymium. But Cockratocalite has a massive endowment of heavy rare earths, specifically dysprosium and terbium. These are the critical elements for high-performance permanent magnets that operate at high temperatures, like inside a missile guidance system or a jet engine. MP is heavy on the lights, Tanbreeze brings the heavies. That geological distinction justifies the premium because the strategic value of heavy rare earths is exponentially higher to the defense sector.
Geology doesn't pay the bills until you get it out of the ground. And getting it out of the ground in Greenland is incredibly expensive. But while you focus on the potential upside, I'm looking at who is selling right now. We have to talk about the European lithium overhang. European Lithium, ticker EUR on the Australian exchange, is the largest shareholder of CRML.
Tony Sage is the chairman of both companies. He has explicitly noted the value discrepancy.
It is a strategic partnership. EUR provides technical expertise, and they birth the asset.
It is an arbitrage machine for them. Let's call it what it is. Every time retail investors buy the Greenland hype and drive the CRML price up, European Lithium sells into that liquidity. They've already sold roughly $50 million worth of shares to a U.S. institutional investor. They just filed a Form 144 to sell another 5 million shares. This creates a permanent wall of supply. Any rally is capped because the largest shareholder is treating CRML as an ATM to fund their own operations in Europe. As a CRML investor, you are fighting an uphill battle against your own major holder who's dumping stock every time you get excited.
That selling is transparent, and frankly, they need to monetize to fund their Wolfsburg project, which helps the ecosystem. But let's look at who else is positioning. The short interest is currently sitting at 10.34 million shares. That's approximately 20% of the float. That is a crowded trade. But here is the data point that matters. 50.05% of that short volume is occurring off-exchange in dark pools.
Which is standard for institutional hedging?
It is standard for institutions who are trying to hide their exposure. Let's explain why. Dark pools allow large institutions to trade without their orders showing up on the public order book immediately. They are shorting in the dark because they are terrified of a retail squeeze. They want to bet against the stock without alerting the momentum traders, but this creates a massive gap risk because the stock is so volatile, moving on political headlines that often break pre-market. The stock can gap up 5 to 10% at the open before trading even begins. If we get a single tweet from the White House confirming interest in Greenland, those dark pool shorts are trapped. They can't cover without sending the stock vertical. The liquidity constraints on the bid side during pre-market mean that any good news creates a bear trap.
I'll concede the squeeze potential is there technically. A short squeeze doesn't need fundamentals to work. But fundamentally, operationally, the timeline does not support the valuation. You mentioned the geology, but let's look at the execution. They talk about a pilot plant, but construction isn't even targeted until mid-2026. Production is years away. And they have this other asset, the Wolfsburg lithium project in Austria. It's a nice diversification, but it is also not generating cash yet. They are burning cash, about $10 million a year, and they just had to raise $50 million in a pipe deal at $13. That is dilution. That is real money coming out of shareholders' pockets.
I disagree on the operational pace. The pivot to the mobile lab is a significant operational accelerator that the market is underestimating. They purchased a $1 million turnkey mobile geochemical analysis center. To explain the significance, previously they had to drill a core, put it on a ship, send it out of Greenland, and wait months for the assay results. Now, this mobile lab allows them to get assay results in 80 minutes using micro-XRF technology. This implies they can drill, analyze the rock, and adjust drill rig in the same shift. That drastically shortens the data loop. It accelerates the definitive feasibility study dramatically.
A mobile lab is a smart purchase. I'll give you that. It increases efficiency. But it doesn't change the fact that they are building a mine in the Arctic Circle. The logistics are a nightmare.
But the asset isn't just the mine. The asset is the geopolitical alignment. Go back to the Saudi JV. The plan is Greenland mine to Saudi processing to U.S. defense end user. This geopolitical alignment is the asset. It bypasses China entirely. It strengthens ties with Saudi Arabia, pulling them into the U.S. sphere for critical minerals. This is why the valuation is decoupled from standard metrics. The market is pricing in the value of a secure supply chain corridor that doesn't exist anywhere else in the Western world. It's a premium for security.
It's a secure supply chain based on a non-binding term sheet and a mine that hasn't broken ground on a pilot plant. The Wolfsburg lithium project is permitted, sure, and has a BMW offtake, but it's small. It's a distraction from the main show. The reality is, CRML is trading in valuation no man's land. It is priced far above its developer peers like Ucore or Standard Lithium, but below the producers. For this price to hold, the U.S. government must execute a historic land acquisition or intervention. If they don't, there is no floor.
The floor is the strategic scarcity. Even if the full acquisition of Greenland doesn't happen, The funding mechanisms are opening up. The European Union's Critical Raw Materials Act is another tailwind for the Austrian asset. But let's be clear, investors are here for Tambries.
Investors are here for the volatility. They are chasing tape.
They are paying for the probability of a paradigm shift.
Look, let's look at the strong sell ratings from fundamental analysts. They have price targets around $14. We are trading at $17.65. That implies significant downside just to get back to a fair, speculative value. And if the polymarket odds dip and say, if the will USA acquire Greenland contract drops below 10%, the trade is over. The correlation is too tight to ignore.
And I would argue that if the odds breach 20%, we will see new highs. The 123% gain in the last month is just the beginning if the political narrative hardens into policy. This is a rare geopolitical arbitrage. You rarely get a chance to buy a stock that is directly levered to a change in sovereign borders. We have a business update call coming up on January 22nd. If the Saudi binding contract is signed, which we might hear about on that call, or if the White House confirms plans, the current price will look cheap compared to the strategic value.
Or, if the January 22nd call is a nothing burger and they just reiterate the term sheet without a signature, the stock could sell off hard. That date is a high volatility event.
Which is why the dark pool shorts are nervous. They know the news flow can destroy their position in seconds.
To summarize my position, CRML has decoupled from traditional mining economics. It's a financial derivative of U.S. foreign policy. It requires the U.S. government to execute a historic land acquisition to justify the price. My advice to anyone listening is to watch the polymarket odds closely. If they dip below 10%, the air comes out of the balloon.
And my position is that this is a binary bet on American strategic dominance. Investors are paying for the option value. If the Saudi binding contract is signed or the White House confirms plans, the Greenland premium is justified. The truth lies in whether one believes the Trump trade in the Arctic is bluster or policy.
On that, we can agree. It is a fascinating, if terrifying, case study in modern market mechanics.
Absolutely. A collision of geology, algorithms, and geopolitics.
We will see what the January 22nd call brings.
Indeed. That concludes our debate for today.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.